What if you could pull 20% a year for over a decade while hedging your US Treasury risk at the same time? That's exactly what this strategy claims. 3 assets, BIL, TQQQ, and GLD. 1 simple grid rebalancing rule. And a backtest running from January 2015 to August 2026. That's 11.6 years, turning $3 million into $26.37 million. Total return, 778.8%. Annualized, 20.5%. And here's the kicker. Only 15 trades the entire time. But there's a catch. There's always a catch. We'll get to it. Every number in this video comes from a backtest using adjusted prices, and the whole thing can be reproduced with a Python script the author is giving away. Stick around to the end to find out how. Let's start with the foundation. Part 1. Why does GLD actually hedge Treasury risk? First, let's be precise. When we say Treasury risk, we don't mean default. Short term, that probability is extremely low. The real risk is the dilution of dollar credit. Look at the numbers. $36 trillion of federal debt. Annual interest payments that now exceed the entire military budget. A fiscal structure that can only issue new debt to pay off the old. And here's the thing. This risk doesn't need to explode to hurt you. It creeps in through 2 slow channels. Channel 1, inflation dilution. Debt gets monetized. The dollar's purchasing power falls. Your cash and your bonds quietly shrink in real terms. Channel 2, the interest rate backlash. Markets demand higher yields on treasuries. Existing bond prices fall. Remember 2022? TLT dropped more than 30%. The classic 60-40 stock and bond portfolio got destroyed on both sides at once, something almost unheard of in history. Now here's why gold sits on the opposite side of both channels. Point 1. Gold is nobody's liability. A treasury bond is an IOU. It depends on the credit of the U.S. government. Gold depends on no counterparty at all. And central banks are voting with their feet. After the dollar was weaponized in 2022, when Russia's foreign reserves were frozen, global central banks bought over 1,000 tons of gold per year, 3 years running. That is the most honest footnote in the entire de-dollarization story. Point 2. Gold is negatively correlated with real interest rates over the long run. The lower real treasury yields go, the more debt gets inflated away, the stronger gold gets. Point 3. The data backs it up. From 2015 to 2026, the daily return correlation between GLD and the dollar index ETF, UUP, came in at negative 0.43. The dollar falls, gold rises. The hedge is real. But here's a critical choice. GLD, not GDX, not the gold miners. Both have the exact same correlation to the dollar, negative 0.43. But GDX is a stock fund. It carries equity beta and operating risk. Over the same 2015 to 2026 window, GDX's maximum drawdown was negative 49.8%. GLD's was only negative 26.4%. When a crisis hits, mining stocks crash right alongside the market. March 2020 proved it. The hedge fails exactly when you need it most. A hedge's job is to be stable, not aggressive. So, GLD. Part 2. How do you make holding GLD bearable? You grid it. GLD works as a hedge, but it's got two problems. Problem 1. Mediocre long-term returns. Over those 11.6 years, it annualized just 11.9%. And it has ugly history. 4 straight losing years from 2011 to 2015. Problem 2. Zero cash flow. No dividends, no interest. The opportunity cost of holding it is very real. But here's the insight. The real problem with holding GLD isn't losing money. It's that nobody can hold on. After 3 years of grinding decline, most people sell right before the dawn. So what's the fix? Turn holding into gridding. Give GLD a baseline market value. If it rises 30% above that baseline, sell a chunk and lock in the profit. If it falls 30% below, buy it back. This does 3 things for you. First, mechanical buy low, sell high. Gold's wide, swinging price action is exactly the fuel a grid loves. Second, psychological shock absorption. When prices fall, you're buying according to plan, not bag holding and hoping. That mindset is the key to surviving a full decade. Third, it turns volatility into income. Even if gold goes sideways for years, every single swing leaves behind a harvested profit. Part 3. Now, how do you actually juice the returns? Enter TQQQ. AGLD only grid has a low ceiling. To hit 20% a year, you need an attack engine. And that engine is TQQQ, the triple leveraged NASDAQ 100 fund. Let's look at both faces of TQQQ in the same backtest. Full position, buy and hold, an annualized return of plus 36.2%. Sounds amazing, right? But the maximum drawdown, negative 81.7%. Do the math. That means $3 million shrinks to $550,000. Nobody on this planet can hold that curve. And TQQQ has leverage decay. In a choppy market, down 50%, then up 100% still leaves you with a loss. But pay attention here. The flip side of leverage decay is exactly where the grid's profits come from. TQQQ is wildly volatile, roughly 3 times the annualized volatility of the NASDAQ itself. Every violent surge and crash is a grid trade waiting to happen. So the right way to use TQQQ isn't to hold it, it's to fence it in. Give it a baseline position. When it jumps the fence, you shear the wool. When it falls back inside, you feed it. And there's a hidden bonus. The daily return correlation between TQQQ and GLD is just 0.08, practically zero. When US stocks fall, gold often rises on safe haven flows. 2 grids taking turns firing. Rebalancing frequency and profits both get amplified. This is a genuine Markowitz free lunch. The returns add up, but the volatility cancels out. Part 4. The final strategy. BIL plus TQQQ plus GLD. A tripod. 3 legs, 3 jobs. 1/3 in BIL, the 1 to 3 month Treasury bill ETF. That's your ammunition depot, earning roughly 2 to 5% annualized in interest. It's also the cash hub for the entire grid. 1/3 in TQQQ, the attack engine, responsible for returns. 1/3 in GLD, physical gold, hedging dollar and treasury risk, responsible for stability. And the rules, there are only 3. Rule 1. On the last trading day of each month, at the close, calculate your baseline, current total portfolio value, divided by 3. Rule 2. If TQQQ or GLD grows beyond 130% of its baseline, sell the excess at the open on the first trading day of the next month. The proceeds go straight into BIL. Rule 3. If either one falls below 70% of its baseline, sell BIL at the next month's first open and top it back up to baseline. Now notice the dual nature of BIL in this design. It's both the risk-free asset collecting interest and the grid's cash pool. Every profit-taking from TQQQ and GLD locks gains into BIL. Every top-up gets funded by BIL. Profit settling and risk redeployment both happen automatically through this one transfer station. Part 5. The backtest results. Let's look at the numbers. Main result, monthly rebalancing with a plus or minus 30% threshold. Final value $26.37 million from a $3 million start. Total return plus 778.8%. Annualized return plus 20.5%. Maximum drawdown negative 39.7%. And total rebalancing trades over 11.6 years, just 15. Now, is this overfit? Check the parameter robustness. Change the rebalancing frequency. Monthly gives 20.5% annualized. Weekly gives 21.4. Daily gives 20.8. Change the grid threshold. A 15% band gives 21.2%. 30% gives 20.5. 50% gives 20.5. Same strategy, almost identical results no matter how you twist the knobs. That's not a single lucky optimum. What about start year robustness? Pick basically any entry year and it holds up, even the top of the 2022 bear market. Start in 2015, 20.5% annualized. Start in 2018, 21.9. Start in 2020, 24.4. Start in 2022, right at the bear market's doorstep, still 16.7%. And after taxes? Using a 20% long-term capital gains rate, taxing every profit-taking event. Pre-tax final value, $26.37 million. After tax, $21.77 million. Annualized return drops from 20.5 to 18.6%. Total taxes paid along the way, $1.96 million. Now here's the analysis, and this part matters. 11.6 years, only 15 trades. That's about 1.3 trades a year. This isn't high-frequency quant trading. It's a lazy person strategy. Check 12 times a year, act maybe once. And everything qualifies as long-term capital gains. The threshold moving from 15% all the way to 50% changes the annualized return by only 0.7 percentage points. That tells you the returns come from the structure, 3 low correlation assets plus grid harvesting, not from parameter tuning. This is the core evidence that the strategy is credible. And that 2022 starting point still delivering 16.7%? Remember what 2022 was. The Nasdaq fell 33%. Treasuries suffered a historic crash. Meanwhile, GLD finished the year roughly flat. And the grid kept buying TQQQ at lower and lower prices through the entire collapse. The tripod's resilience was validated in real combat conditions. Part 6. The comparison. What if you just bought and held? Same window, 2015 to 2026. Here's the full lineup. Full position in TQQQ, buy and hold, 36.2% annualized. Maximum drawdown negative 81.7%. Ending value $109.03 million. Equal thirds, buy and hold, never rebalanced, 25.3% annualized. Drawdown negative 73%. Ending at $41.36 million. This strategy, the BIL, TQQQ, GLD grid, 20.5% annualized, drawdown negative 39.7%, ending at $26.37 million. Full position GLD, 11.9% annualized, negative 26.4% drawdown, $11.06 million at the end. Full position BIL, 1.9% annualized, a drawdown of just negative 0.2%, and $3.75 million at the end. This table deserves a second look. First, holding TQQQ has the highest return, but it's paper wealth. That 81.7% drawdown happened across 2021 and 2022. Real human beings sell somewhere around negative 60%. They never see the recovery. That 36% annualized in the backtest, almost nobody can actually collect it in real life. Second, buy and hold with no rebalancing is the most underrated bad plan on this list. 25.3% looks decent, until you see the negative 73% drawdown. Why so bad? Because it lets TQQQ swell to over 90% of the portfolio. You end up with the worst of both worlds, effectively all in on TQQQ, but not fully invested during the run-ups. Third, this strategy spends 4.8 points of annualized return, from 25.3 down to 20.5, and in exchange it buys out 33 points of drawdown, from negative 73 to negative 39.7. Look at risk-adjusted returns, annualized divided by drawdown. The strategy scores 0.52. The unbalanced third score, 0.35. Full TQQQ scores, 0.44. The strategy is the best on the field. And let's be honest, negative 39.7% is still not a small number. This strategy is for people who can stomach watching their account sit 40% underwater at the deepest point. If you can't handle that, the answer is to lower the TQQQ weight, not to abandon the discipline at the bottom. Part 7. The honest risk disclosures. Do not skip this. Number 1. The backtest window, 2015 to 2026, was a super bull market for both the Nasdaq and gold. 20% annualized over the next 10 years is not a promise. It's a conditional probability, if and only if this structure persists. Number 2. TQQQ carries leverage decay and even liquidation risk. In extreme markets, a triple-leveraged ETF can get cut in half in a single day. Position discipline cannot be broken. Number 3. Taxes here assume a 20% long-term capital gains rate. But GLD in a US taxable account is taxed as a collectible up to 28%. And this backtest does no tax loss harvesting. Your actual tax burden will vary. Number 4. Slippage and commissions are not included. With only about 1.3 trades a year, the impact is limited, but it exists. So here's the bottom line. Every number in this video was generated by one Python script built on public wine finance data. You can modify the tickers, the periods, the thresholds, the tax rates, and verify everything yourself. If you want the full backtest script, drop your email in the comments and it'll be sent straight to your inbox. And here's the first thing you should do when you get it. Change the starting year. Change the parameters. Run it again. Because whether a strategy deserves your trust isn't about how good it looks at its best. It's about whether it stays decent no matter how you twist it. So what do you think? Would you give up 5 points of annualized return to cut your drawdown nearly in half? Let me know your take in the comments. And remember, this video is for educational purposes only. It's quantitative backtest research, not investment advice. Leveraged ETFs carry extreme risk. Always make your own independent decisions.